There is a number sitting on your paystub right now that most Canadians never dare to look at. It is not your gross salary. It is not your net deposit. It is the gap in between, the silent space where income tax is deducted before you ever see a single dollar. The average Canadian working a $75,000 job hands over roughly $18,000 a year to the taxman before the money even touches their account. Think about that for a second. That is a used car. That is a full year of groceries. That is a maxed out TFSA contribution, vanishing every 12 months into a system that never says thank you. And here is the part that will bother you. Much of that over-withholding can legally be reduced for eligible Canadians. There is a specific tax strategy buried deep inside the Income Tax Act that the wealthy have quietly used for decades. Your neighbor with the paid-off house and the cottage in Muskoka almost certainly knows about it. Your coworker who retired at 58 may have used it, but your bank, your payroll department, and your HR portal rarely mention it, because the moment you understand this mechanism, you stop being a passive employee and you become a strategic taxpayer. So today we are pulling back the curtain on the single most underused tax provision available to a working Canadian in 2026. Let us start with the problem. Every 2 weeks, your employer runs a calculation. They look at your annual salary. They assume you will earn that exact amount all year. They apply the standard tax rates to every paycheck, and they send that money to Ottawa immediately. This is called source deduction, and it is designed for the CRA's convenience, not yours. The average Canadian earning $85,000 in Ontario loses about 26% of every paycheck before it lands in their account. That is roughly $1,700 gone every single month. Now here is what nobody tells you. The CRA is not entitled to that full amount yet. They are just holding it, interest-free, for up to 16 months, waiting for you to file a return and ask nicely for some of it back. That is what a tax refund actually is. It is not a gift. It is not a bonus. It is your own money being returned to you after the government has used it. While you were potentially struggling with inflation or debt, this is the trap. And here's the mechanism that breaks it wide open. It is called Form 1213, the request to reduce tax deductions at source. It is one of the most underutilized tools in the Canadian tax system. Yet this single document can put hundreds of extra dollars into every single paycheck for the rest of your working life. Here is how it works. If you make regular RRSP contributions, if you pay spousal support, if you carry investment loan interest, if you donate to charity, if you have childcare expenses, or if you carry rental property losses, you are legally allowed to ask the CRA to reduce the tax your employer withholds right now, not next April. Let us run the numbers. Say you contribute $12,000 a year to your RRSP. That contribution gives you a tax deduction worth roughly $3,900. At a typical Ontario marginal rate, most Canadians wait until tax season, file their return, and get that $3,900 back as a refund 14 months later. The 1213 filer does the opposite. They submit the form in January. The CRA routinely processes these requests when the required documentation is provided, and once approved, your employer is instructed to withhold about $325 less in tax from every single monthly paycheck. Same contribution, same deduction, but the money lands in your account immediately, not 16 months from now. To see how this works in real life, imagine an Ontario teacher making $85,000. She has childcare expenses, and she also owns a small rental property that runs a paper loss. Normally she would wait an entire year to get her $4,000 refund, but by using this strategy, she adds over $300 to her cash flow every single month, starting in January. Now multiply that across a decade. $3,900 a year invested inside a TFSA, earning a modest 7% return, becomes roughly $56,000 in 10 years. That is the real cost of letting Ottawa hold your refund. You are not just losing time, you are losing compounding, the single most powerful force in personal finance. So why is this so rarely discussed? It often comes down to a lack of awareness. While wealth advisors for high net worth clients often file it every January as standard practice, the average bank employee opening TFSAs and mutual funds for regular Canadians might never mention it. The system is not built to prioritize your monthly cash flow. It is built for efficiency. If you use this form correctly, you fund your own RRSP with your own paycheck, and this can reduce or even eliminate the need for high-interest RRSP loans. This strategy quietly bypasses the need for many of the most profitable debt products in Canadian retail banking, and it works for anyone who has legal deductions that the CRA already recognizes. Most Canadians will think this must be some gray zone trick. It is not. The form is published on the official CRA website. The processing is routine, and the system is there for you to use. This is not an overlooked provision in the illegal sense. It is simply a little-known provision, where almost nobody knows the door exists. Now here is the question that separates the strategic taxpayer from the passive one. If the CRA gave you an extra $300 a month, starting tomorrow, would you actually invest it? Or would it disappear into lifestyle creep? Because this is the part where the focus shifts. It stops being the CRA, and it starts being your own habits. Many financially organized Canadians who use the 1213 do not spend the extra cash, they automate it. They route it directly into their TFSA, into their FHSA, or into a dividend reinvestment plan. On the same day the paycheck lands, they turn a tax refund into a wealth machine that compounds silently in the background for 20 or 30 years. This is the real secret. It is not the form, it is the discipline of what you do after you unlock the money. So here is my question for you. Which would you choose to fund first? Would you kill high-interest debt? Would you max out your TFSA? Would you build a FHSA for your first home? Would you start a drip inside a Canadian bank stock? Drop your answer down below, because the plan you commit to today is the retirement you will actually live tomorrow. Many successful Canadians do not necessarily earn more than you. They just refuse to let their money sit in Ottawa's account, collecting no interest. For many Canadians, a large refund is often a sign they paid more tax during the year than necessary. The rich are not lucky. They are just paying attention. Subscribe and join the quiet minority of Canadians who have decided that their paycheck belongs to them first and to the government last. Because in this country, the tax code rewards the ones who read it and quietly drains the ones who don't.